That's the thing which you can be certain of, that IV will ramp up before the event and it will definitely go down.
Earnings season can be a gold mine or a trap for options traders. Today, Daniel Nikolaides joins me from Germany to break down how he approaches earning events with discipline and precision. Let's get started. Welcome, Daniel.
Hello. I'm happy to be here. I've been a big fan of all your videos and everything you have shown and done for the options community, especially here in Europe. And I'm very happy to talk about this very special topic with you today.
All right. So give us the story of why you trade earnings events.
Basically, I trade earnings because these are short-dated options, and basically you see a mispricing in volatility. Normally, premium gets inflated before the announcement. There's a lot of uncertainty in the market. The market is nervous. But Theta is on steroids, as I would say, because it decays fast, and volatility usually goes back after the event. So basically, you have some average move, and from that, you can win some structures. And this is something which happens repeatedly all the time. And this is something you can put into a structure, which you can trade very disciplined and have great gains. And you can manage the risk accordingly if you calibrate right.
I'm very eager to get into this. But first, tell us a little bit about yourself, both as a person and options trader.
Yeah, for my background, I come from Germany, living in Berlin. I also have a Greek background. I have a background in law. I'm basically a civil servant in parts of procurement law and have a leading role there in Germany. About options, from investing, long-term investing and all these structures there, I came to options, which can be on the long term, but basically it's more of a short-term trading. The thing is that I focus here on volatility mainly and Theta. That's why I'm also here, because we talk about Theta profits. And earnings are basically one of my main events and setups I use alongside short or long dated volatility trades. I will explain later, but today, basically, I want to focus on the earnings.
How popular is option trading in Germany?
It is really coming. A lot of people are asking questions, and I see in all these channels and different various discords and groups I am that many German people, at some point, they find out that I have a German background, and I have a lot of colleagues who have gone pro, basically, and it's become very popular. And everyone is looking to the other side of the pond, what is happening there, because everyone is trading the option markets in the United States and not the leaps here in Europe.
And I'm very happy to also have a guest from Europe in this show. Let's move to our topics today about earnings trades. So let's start with the basic first. What happens typically around an earnings event when it comes to IV and other factors that is relevant for understanding the trades we are going to talk about today?
Yeah, that's the precise thing. You have to know about volatility and what happens basically into earnings, because as we said, the market doesn't know what will happen on that day, what a company will report and how the algos will move the certain stock. And basically into earnings, volatility rises, it ramps up. I always try to explain it as you have a balloon which inflates. It might inflate slowly, but after the earnings event, it deflates. Doesn't deflate right away, but IV goes down. And as we know that options are moved by price, volatility, and time, Theta. And this is one of the main movers. That's the thing which you can be certain of, that IV will ramp up before the event and it will definitely go down. The easiest thing is, and I always advise that before you use any tools or do something else, just take a look at an options chain. And each broker you use will show you the IV, the average IV for the options, the closest options, and then go a week out or go a month out, and you will see that IV is totally different there. If you look at stocks which have earnings next week, you will see IV maybe doubled from what it is if you look a week later.
And this is what you benefit from. And today we are going to talk primarily about earnings trades that short the volatility as the earnings events is happening. And very briefly, what kind of strategies are we talking about here that we will go more into depth in later in the show?
The main strategies for short-term volatility trades, yes, you can have the very basic short straddle or the strangle, but these are naked options. So we will basically look at iron condors. We will look at flies, skewed flies most probably, and I will explain why. And in certain cases, we will also look at calendars and time spreads, which are a little bonus on the whole thing.
All right. And I guess the first step must be to pick the right stock that will have an earning event coming up. Can you take us through your process of choosing the underlying that you will do the trades on, and why you choose some stocks and why you don't choose others?
The first thing, and this has nothing to do with earnings, and this is something I can only advise, is do not pay up too much in slippage or in brokerage fees or other stuff. So I will mainly focus on liquid stocks. Yes, you can have great trades on smaller stocks, especially on all these meme stocks, but this is a story for another day, how you can do that. But the first thing is I look for liquidity. So I will take a look what earnings are up this week. We will look at a certain tool I use for this later, which makes my life very easy. Everything is laid out and you can just click a button and you have the liquid options. But you can do it easily on your own. Just take a look again at the options chain. I call it the caveman style. Just look at the options chain. And if you have learned the basics there, then it's very easy to see which options are liquid. So I would suggest to look at the money strikes and a bit further out and to see if the difference from bid and ask is roughly around 10 or below %, then it's okay. Then it's liquid. Another way of finding liquidity is to see if stocks have weekly options. If they don't have weekly options, normally I will skip them. The second process is basically I will take a look at the historical patterns. Yes, we learn from history. Does history repeat itself? Not always, but a lot of people trade seasonality, and in earnings you can trade on historical data. And this is most of the times even more important than the positioning of the market and all the flows. I've done some research on that. So I will look at the average move versus the implied move and also factor in the standard deviation. I will look for a symmetric setup. So basically, sometimes you have stocks which, if they move, they will move 10% on the up, but only 3% on the down. If this happens repeatedly, then I won't go for just a home trade 10% on the up and 10% on the down to be safe. So I would try to skew that. There are other metrics beside the historical moves and the move after the earnings event, which help you to see how the market is positioned, how it will react, where there might be some zones which are interesting if the event has happened and deflation of volatility is happening and other metrics, the normal metrics kick in. So I will look at the delta exposure, so what market makers are doing, and where the magnets are, GAX levels. But this is just the secondary levels. Yes, and intraday flow is important. So I always try to set up my earnings in the end of the day, 15 minutes maybe before the close, because then IB has ramped up and very nicely you get well paid and there are no surprises. As I try to close the trades in the beginning, but everything is pre-managed. We will have a deeper look in a moment.
So this is a lot of data that you are looking at, and historic patterns, delta and volatility, etc. So maybe it's a good idea now to look at an example and how you actually use a tool to find all this and analyze all this data.
Yes, this is a tool I came across a couple of years, and this is a wonderful tool which really helps me do earnings trades, let's say the easy way, not going through the options chain and asking AI to help me there and with all its problems with data. So this is a tool which is called Earnings Watcher. It's been built up from scratch, and basically it's a tool because it's built with the demands of the users. The easiest thing is I use the home screen, you have some stats down there, but I always start basically here because I want to make my life easy. I don't have that much time to spend on trades, time is money. Really, not only how long you are in the trade, but how long it takes you to set up a trade and to manage a trade. So the easiest thing is to see a pre-selection. We see different strategies here. We want to talk about short volatility strategies here. So this is easier for the coming week. We see on the 19th before market open, we have low. This is basically a stock. I've tried it a lot of times. And the nice thing is it's very easy here. So if you just want to be on the safe side, you want to have statistics on your side, mathematics on your side, this is something I would focus in. Basically here I see that we have a very nice, it's green. It explains why we have the beat rate of the actual move versus the implied move. And this is what is interesting for us. On a 10-year scale is only 40%. This means the stock normally stays below the implied move. What is the implied move? This is the move which the market is pricing in for the day of the release. So everyone who knows about the expected move, I don't need to explain much more. If you want to have it roughly, but not correctly, just use the at the money straddle to see what the move might be. So this is something which gives me an idea. I see what the average is plus the standard deviation. We will see how we use this for basically for our risk management, and we see the implied move. As I said, this is on the 10-year, so we know that stocks change. We see all these AI coming and everything. So this gives me a good idea how a stock has behaved in the last 10 years. And the easiest thing is to deep dive into the stock. So you see here from 2013, the first thing I would do is to go down to the 2 years and take a look how things have happened here, what has happened here. So keep things simple. We had 2 times where the actual move beat the implied move. So when it didn't beat, basically it stayed 1% below the implied move, which is very nice. Theta is bleeding out, and volatility basically is in very fast decline. So basically on the first day of this trade, you're already sitting at 25-50% of gains, and you can close within minutes and are very safe here.
Yeah, so just to make sure that I understand this, this seems to be a good trade because the move that the market has priced in is bigger than what it has historically been in most cases. And the few times it has gone beyond implied volatility, it has gone very little beyond.
Yes, this is something which you always should have in mind. You need statistics, and you will have winners and you have losers. You have losers. The question is how you avoid that. This can't be avoided all the time. The market is unpredictable. But just because you have statistics doesn't mean the market will behave like that. But in normal cases, if nothing really out of the order happens, you just have a 1% move. So this means you can manage that. If you know some other levels, if you know how the market is structured, how the intraday flows are, then you can adjust. Or what I do a lot of times, I already factor in what happens if the market moves, let's say 1% more, then I know what my loss is, because most probably this will be a loss which is calculated in the trade setup, and I'm okay. I will move on, because, and this will be maybe something we should talk about, how much of my buying power should I put into the trade? How confident am I? So if I'm confident with this trade, this is something Mark Douglas said, anything can happen when you go to the market, but you should be ready to take the consequences, and it's not on the market, it's on you. So you have to look at the statistics and be ready even for the losses. So be ready to manage that. But these are the factors which make this a good trade on the statistics side.
Okay, so you have found a stock that you think has a good potential. The next step then is to decide what kind of trade you want to put on, what type of strategy you want to use. Take us through your process on that.
As I said, we looked at different metrics. So I would try to find a strategy which has a break-even point close to the 3.6%. And another thing I would look at, as I said, is, do I need to skew? If you want to keep it easy, you keep it balanced. And we will take a look at that in a second. But the easiest way would be to find something roughly about 3.6%. If I skew, we see that normally we have a move to the downside. This means If I have an iron condor, for example, which normally is balanced, I should be worrying more about the downside move statistically. And especially if you look at the market position before ahead. But if we have, for example, a butterfly, if we have a broken wing butterfly, which will help basically reduce the risk on the one side, or because we don't have a big move, we can even think about a calendar. So the next thing I would do would be very easy. I would go to the simulator. So you see the actual stock price. Basically, we're not live right now because the market is closed, at least for the options. And the easiest thing would be, because sometimes if I don't have time, I will try and let the system maybe give me something which is helpful. So we saw that the average move in the last 2 years was 3.6%, and the market was pricing in 4.8%. So look at these strategies here. If we go here basically on a short straddle or short strangle, for example, this would be strategies would be very nicely would work very nicely because we would stay not only in the range of the implied move, but also in the average move. But you need to know how to manage these kind of things. Basically, you can go even further out. You can just collect $1 and basically you have low risk and low reward, but this makes things very easy. The other thing is we could take a look at flies. We remember 3.8, and I was more afraid about the downside, as you remember. And we had the 4.8% move implied, but I know we should stay in the range of 3.6%. If we add the 1%, it's roughly 4.6. So basically something down here would be something to consider, where you sell the at the money strikes and try to find the according wings. You can choose that. Let's take a look. The system tells us one of the legs has low volume. And we talked about liquidity. This might be a bit dangerous. So maybe you want to avoid that. But let's stick with that. The first thing I look here is how is the IV right now and how much will it deflate? The deflation is not that big, but it's also something you definitely factor in. Let's go down to our simulator. We said the earnings event was on the 19th before the market opened. If nothing happens on the 19th, you see here the break-even points are calculated. If nothing happens, if the stock wouldn't move, we would be already sitting in roughly 60% of profit. If we have a smaller, lower move, you can always adjust here. You see it decreases, and I will talk about how you can manage that and at what I look if I want to keep this trade running. If we have a higher move and it takes extreme moves like 8%, then I know I would be sitting here at 3.5% loss. The other thing is what happens if I have a crash move on the upside. It's roughly 50%, and I should be ready to take these losses. And this is the thing with the butterflies. We will set up some condor later, and we will also take a look at basically a calendar. Because 3.6% is not that much, maybe a calendar could also make sense here. If we have a lower move, you see again, we are already sitting at 35% of gains. This always is calculated on the 10-year. As I said, I go normally with 2 years out of experience, because stocks tend to change. Some stocks stay the same for the 10 years, but we saw really some changes and low from 10 to 5 to 2 years. We didn't go through that process, but this is something which always is something I would take into consideration.
One question, there is a premise in all of this that history repeats itself, that you can somehow trust the historical pattern, or that it gives a bigger chance for success if you follow the historical pattern. But history does not always repeat itself. How reliable do you find the historic pattern to predict what will happen today?
Yes, this is a very good question. And this is a question I always had pondered myself. Basically, the selection we made from these special handpicked trades, they are very reliable. You had a very high win rate over the last years because they really deep dive into that and try to also take other factors in, like market moves and positioning and other stuff. If you just pick out a random stock where you see some historical patterns, then it's more tricky. So in this kind of case, I would either size down or I would even look for more confluence with the positioning of the market and basically with intraday flow the last 2, 3 days before and on the earnings day. These are two factors I will always take a look in. And if we build another trade like an iron condor, for example, later we can take a look at how to build that and how to use basically the positioning of the market makers, but also where the magnets are and to see what the flow is telling us.
So, Daniel, let's now go into the three strategies that we have mentioned: iron condors, butterflies, calendars. And let's start with an iron condor. When will you put on an iron condor and how will you use it in an earnings event?
Yes, an iron condor is like many people think of iron condors as two basically PCS and CCS from both sides, but I would think it more as a short strangle with which comes with a life insurance. So I would use it in two certain cases. If I see that the moves of a stock which I've selected, especially for a short volatility trade, the moves up and down, they have kept roughly at the same pace. It's not like skewed 60-40 or 70-30 even to the one side. Plus, and this is the next layer I will add, I will look at the market positioning. So if I see that I have a stock like low, which tends to go lower on, like the name suggests, on earnings, and I see that in the market makers books, we have a lot of puts there, then there is something tells me that most probably we have to skew that way and that there's a magnet. So if volatility deflates, that might be a problem. So in this kind of cases, I won't do the iron condor. I will do the iron condor if I see, as I said, it's very balanced, plus the premiums are right, plus in the cases where basically the positioning and the flow has been very open-minded, let's say, open-minded trade to both sides. One side might lose, but the other side will gain. And as long as we stay in the break even, everything is good.
So if you decide that the iron condor is a good strategy for this trade, what are your mechanics, so to speak, rule for how you put it on and when you will close it?
Yeah, the mechanics are very simple. Basically, I will try to find a break even close to what the average move has told me. Plus, I would look at the positioning of the market. So if you remember, we had roughly 3.6%. So I would try to find on both sides the 3.6% as a break even point. And then I will see if there are important levels in the positioning of flows. And I would try to set my trade there.
And you are setting it up at the end of the day before earnings.
Yes, because as I said, as this is a short volatility strategy, it ramps up and premiums are rising. And yes, for both the long and the short position, the premium goes up. But I've seen big moves intraday, even in the last hour. Sometimes happened to Amazon a couple of earnings seasons ago. And then everything is out of balance. So if you have a stock and you have set your, let's say, 4 to 5% average move and you have set everything right, and in the last moment the stock shifts to one or the other side, then your iron condor is, without you wanting it, very, very skewed. And then you might have a problem.
What is the expiry you are using? The next expiry after the earnings event?
Yes, for short volatility trades with iron condors, strangles, butterflies, I always use the closest expiration because the theta burn is the highest and the IV is ramped up the highest. So this means the effect is the biggest. For long trades, I normally go out 1, 2, or 3, or maybe even 4 weeks just to be safe.
And what are your rules for closing the trade, for taking profits or accepting a loss? When will you do that? At what level?
Basically, that's very easy. Normally, with stocks which are liquid, I will have a max of 2% of my buying power. And some people go up to 6%. So I'm ready to take the full loss, but this is not my aim. Normally, I won't only trade one contract there, one setup. I try to go in and let's say I have 4 contracts. I will take out 1 or 2 of them when they at 25 or 50% right away within the first minutes. Then I would try to take one out with 75% and I would leave a runner, which is house money in the end.
So the other strategy we talked about is butterfly. When will you choose to use a butterfly in these type of events?
Yes, a lot of people use butterflies there, which is very simple. That you have the shorts are set at the money, and the longs are basically not basically can be on the same difference strikes, 3 strikes out, 4 strikes out. But I will use normally the butterflies when I see that the move won't be that crass, that I expect a lower move. Let's say like here in low, we don't have a stock which has a lot of volatility. So in these kinds of cases, I would prefer most probably the butterfly. But as I said before, we saw that the move normally happens to the downside. I would lean towards a broken wind butterfly. I would try to skew that a bit, but this is not a must.
So what would be a practical example of such a butterfly earnings trade?
The easiest one would be the normal one. You take the at the money strikes and go out with the wings. If you know that there is a lot of positioning, let's say you take the 232 here and you see that there are a lot of calls on the upper side, you will go out and go to 240 and go down to the 220. But if you want to skew that because you're afraid that it goes down, the typical one would be, let's say, we are not on the 232 right now. We take a round number. The easiest way would be that you skew. Basically, you take the 230 at the money put and at the money call, you sell those ones. You go a bit closer with your call and go a bit further out with your put. And the easiest way, I always try to explain that. Start first, maybe if you have one strike, if you're one strike away, let's say we have the 230 and the next strike would be the 235 on top, then you just double that and you go down $10 down. But if you want to really skew, because we saw here you have a 60% chance that it goes down, you can even double that and go down $20 or maybe just $15. And then you have a skew butterfly, which helps you accelerate the downside risk. I like that because it's a cheap defined risk payoff. Basically, it's not that expensive. You are at the money, which gives you a lot of premium. And you also have the skew inside. And yes, the only downturn with iron condors and butterflies, even if they're skewed, you have 4 options you have to manage. But normally you only have to take care of one side.
And then we have the calendars where you have only 2 legs to manage. When would you choose to use a calendar and how would you use a calendar?
A calendar is a time spread and a lot of calendars and a great statistic that these work very well when you have the situation that there is a misprice. And when we do short volatility trades, normally we know that we sell a mispriced option based on the historical data, but I will also look how IV has been moving and how the front and the back month is priced in. And a good metric is basically to, again, choose. The question is first, do you choose a call or do you choose a put? So for example, for low, because we know that it will, that we at least would predict and what we see from market makers positioning and the flow of the last days, that it could go down, but it's most probably going down. What would you choose? I would choose and prefer a put calendar in this situation because what happens if we drop the front month, basically the short put that I've sold at the money, basically it will lose fast value and will go out of the money. And the long call, yes, it's bleeding. And what happens, and a lot of people get afraid if the move is bigger, because with calendars, you're not allowed to have a very big move because calendars stay, and we will take a look at the platform soon. They need smaller moves. But if I see that IV is overpriced, and especially there's a divergence from the 1 week to the next week where you have good liquidity, or you have good liquidity a month out because you have 2 monthly options you can choose when you're lucky, then basically it is a good strategy because you will, on the one hand, have liquidity and you have time to manage the option, especially the long option, because the short option is something which will most probably you can just close on the first day, or you roll it out and then you manage your long a bit later. So this is something very easy because you only have 2 options to manage.
How long time would there be between the short and the long option in your calendar for earnings?
The study suggests about 30 days. A lot of people don't like that because they have to pay more debit. We shouldn't forget, normally a calendar is for a debit. But in the end, you end up with a credit and everything goes fine because the short option where you got the premium is bleeding out, IV deflates, and the long option is not that impacted because it's further out, especially when it's like 4 weeks out. If you want to be sure and close to liquidity, then I would choose a week out, but it depends on the stock. Nvidia is so liquid every week, you can choose each week. A low might be a stock where you have to think, is the next week good, or is maybe a week where we have a monthly expiration better?
So the short at the next expiry after earnings event, and the long about 30 days out.
Yes, this is a good metric where you can work with. Yes, this is a good, yeah.
And you would close both of them at the same time.
And I would close most of the time, both of them on the same time. But let's say we build a calendar, put calendar, and we stay in range. We stay within our average move and what the break even is. And I let the short expire. For example, if I see that the move is not happening, 2 things help me with that. One thing we can look here at the platform is the PED. You had a very nice video about that, is basically how stocks behave after the earnings event. So if I know that the stock moves in range or will trade a bit further down, then it's fine. My short put, which basically ends this week, will just end out of the money, and the long, and basically, yes, it's losing a bit of theta, but it grows because it is a long put. I would keep that on. I would definitely look into the positioning. I would look at the delta, at the DAX basically, and how it has changed after the earning. And I would look for GEX levels, which tend to be magnets, and sometimes I would manage them. But if I will be honest, because I don't have much time and I prefer to do things quick and dirty and don't have open loopholes and things to attend about, I like to work with buy to close orders and everything organized before. I will try to close these calendars right away in the beginning of the day, the latest in the end of the day.
Shall we look at one trade like that on your platform maybe?
Yes, we can try do that. And if you can see my platform now we have low here, which has on the 19th, we have the monthly here, which we are very lucky, the 21st of November. So we are here on 232. We have to just pretend tomorrow before market opened are the earnings. This is something we would set up again in the last 15 minutes. And would I choose a 232? Yes, I could, because I will roughly go out a month, so to be at the money. But because I believe that we might go down, first try would be I would go to the 230 here on the short. Then I will go out a month, roughly, again to the next expiration here. So then we choose our long, 230, a month out, and let's see what the platform gives us here. So you see here how much the IV will drop. It calculates the stuff. So basically we have a break even of minus 4.2%, and on the upper side, 2.7. Are we happy with that? We could, because we know that the move is 3.8. We have a standard deviation of 1%, and we are safe on the downside, which we expect. And on the upper side, yes, we might have a problem if the stock moves up. Let's take a look here. So if we have even a 3% move, we might be in loss here. But you see, as time passes, and this is a nice thing with time spreads, we might have another chance here that we go in and have a winner in the end. Let's see what happens with a downward move, which we expect. Otherwise, we wouldn't have chosen the puts. We would have chosen the calls. this is even easier. If we have a lower move here, roughly, we are still fine. What happens with a high downward move? Yes, then things look differently. It's 70%. And how would we manage that? There are two things. We will have to look at how the stock normally behaves, which problem it might have if it moves much. So we know 8%, and we should be ready to take this. And what can I do? Two things I can do, or three things basically. As I said, I will look at the peak. So if I know that if there is a downward move, which is bigger than what I expected, and from historical, from history and all the statistic plus the positioning of the market, I know that the stock normally, if we have basically a downward move because we didn't have an earnings beat, for example, will even go lower in the next week or 2 weeks because we went 30 days out. Then most probably I would just either take the loss or I would manage the short, roll it out, and basically close the long put for finding wind and try to basically break even.
We have been through 3 types of earning events trades that are trying to benefit from shorting volatility. What is the worst that can happen with this way of trading?
The worst which can happen is that you have a long series of losers, and even worse thing is that you trade them on short. You trade short strategies like short straddles or short strangles and have really, really big moves. And this can be very costly and might take you years to roll that. Basically, you won't be able basically to make that back. So, but normally if you calibrate right and if you take strategies like we showed the iron condor, the butterfly, skewed or not, or the calendar, basically the risk is not unlimited, at least if you manage correctly.
Daniel, I always ask my guests where they would put their strategies on a risk profile scale from 1 being very low risk to 10 being a very high risk. What would you say?
Try to rank this in my head. The condor, basically, I have it on a risk, basically on a 5 to 6 scale. If 10 is the worst and 1 is the best, I have the butterflies also at the 5 and the skewed ones, because then we take more what the market is telling us and what history is telling us. I have them at the 4 level, and the calendars, if I have found the right stock for the calendar and the statistics are there, I also have it roughly with a 4, max a 5.
What have been your results of trading these types of earning events? What can you share about that?
I can keep it short. Since I really develop my strategy and stick to the plans I have, plus I look for confluence and have good management rules, in effect, I can say these are many repeatable small wins. Sometimes you have break-even trades, but some controlled losers or losers which I have turned around. So on the long run, this is something which is always there. You can do it 4 times a year. And basically, it's something which gives me really, really great returns and is a very good and manageable way if you don't have much time to be in the options market and make a consistent income. Maybe achieve that which all options traders try to achieve, some consistency.
How would you sum up what we've been through in a few words? And also, what would be your 3 to 4 most important takeaways to share with our audience?
It's a great way to trade Theta, and that's why we here at Theta Profits, and to trade volatility because it's something which is repeatable. I like mathematics, I like statistics, even if I have a background in law, and everyone believes we can't calculate. But I've seen there are patterns, and nothing is better than to trade something which has patterns and have the statistics and mathematics on your side. So if you manage right, calibrate right, use the right tools and have the right mindset, this is something which not only can give you consistency and an income, which can in the end be also fun.
What would be good resources to learn more?
Good resources are, there is so much stuff out there. I showed you here this platform, Earnings Watcher. There are some articles you can find. There's another platform called, this is not advertisement, Medium, where people write about stuff, also about earnings. I read a lot of educational material of the CBO because it's available, it's for free. You have a lot of great sources on YouTube here, but I advise everyone to look at the host first, because not everyone is taking things so seriously as you do, and they try to sell you something. So this is a great way to learn about earnings.
Would you have a couple of good books to recommend about options trading?
The book which I believe everyone should read in trading or investing, or even helps in life, it's Trading in the Zone by Mike Douglas. This is the book which has helped me achieve consistency, and it's more about mindset, but a lot also about trading. Other things which have helped me are classics. Was called Options Volatility Trading, I think, by Adam Warner.
Daniel, thank you very much for sharing how you trade earnings in such a systematic way, and also showing how you use the tools. Thank you very much for joining.
Thank you very much for having me. I hope someone can take something out of this. And if you have questions, please write on Theta Profits. I will try to answer your questions.